We are witnessing a complete collapse take hold. Record-breaking stats are pouring in as we have expected. Demand has completely fallen for most goods and services, and the statistics are now showing that very clearly. Unemployment has now hit the tipping point which historically it can't come back from without activating a recession. Interesting times. You came here for the truth, so let me unveil that for you. Today we are going to look at all the statistics you need to know. We're going to talk about what's going on with the jobs, unemployment. I'm going to show you different ways to look at that. I'm going to give you everything. Let's begin. Directly from the BLS website, we're looking at the U3 unemployment rate. March 2020, it is sitting at 4.4%. This is huge. Now, of course, we get the information afterwards, after it's all tabulated and padded to make sure it looks nice and pretty. So we know this is heading upwards, going up and up and up. And the expectations for many are 15% unemployment. That would be extreme. That would be beyond what we saw during the financial crisis. Others have said 30% and some say 20%. Anyway, regardless, we'll see what they provide. What we're looking at here is the U3 unemployment rate. You can also look at the U6 unemployment rate, which is, I believe, a much more accurate depiction. Not completely accurate, but at least a much more accurate because it's going to include those who don't have full-time work. Maybe they can only get part-time, but they really want to be working full-time. It's broken down further, but essentially it just gives you a better picture of what's going on with unemployment. So that's why I see it as more accurate. Shadow Stats has their own, and there are others who recalculate the data too. The tipping point has been activated simply because we moved from a rate of 3.5 to 4.4. Yes, there are always going to be variances. It goes up 3.6 to 3.7, then it comes down to 3.6, then it's down to 3.5. But in percentage terms, when it increases this much, on a historic basis, it's basically a guarantee that a recession is coming. As I said, you get these variances that occur. It's very natural. The unemployment rate is not going to always be the same. However, when it's a big spike upward, clearly something is wrong, and then it shows up in the stats afterwards. We know all the data as it's coming through. You're seeing little bits and pieces. This company's laying off, that company's laying off, stores are closed. You've been seeing everything in the news. Then we get the unemployment rate later on. So the number itself, as far as I'm concerned, doesn't matter. What really matters is the people. Unemployment is definitely a big issue, not just for me, not just for the Money GPS. What you're looking at here is Google Trends, and this is a really good way to determine what's happening. If you don't know what this website is, essentially trends.google.com, what you're seeing here is people going to the search engine and typing in a particular term, in this case, the word unemployment. And you can see it over the past 12 months. You could stretch that back even further. What we're looking at is basically the entire time where there isn't much interest whatsoever, and then we get the March and it spikes up dramatically as these companies have been laying people off, as more people are concerned, as it pops up in the news more and more. This is broken down by state as well, Nevada on the top of the list. I really like the second and third tier indicators. If you've been on this channel for a while, you know that, because it gives you more of an insight as to what's really going on. If you're just going to focus on the unemployment rate as the U3 and you're going to use that as, the only indicator or one of just a handful, you're not getting the full picture. We're on a completely different page. Same situation for business loan. This is going back 5 years and there's variances in the interest, but right now it has spiked upward dramatically. Just like the average person, the average business is running paycheck to paycheck, and that is never a good sign. In this case here, New York is in the top spot. U.S. payrolls plunged 701,000 in March amid the start of a job market collapse. Now you know exactly what's happening. There's no way to deny it. This is only the beginning. This was the first decline in payroll growth since September of 2010. We're going to see a lot of those statistics today and as we move through. Here's the labor force participation rate, and I want you to focus on the bottom right corner. You can see that this has basically fallen far down. So this is giving us a little bit of insight at what's happening in the labor force. The trend has been since 2000 that this was going further and further down. In the last little while, last couple years anyway, this had started to trend upward. They started to point to how strong the economy was, how fantastic it was becoming resilient, and so on. The truth of the matter is that when you actually look at the data, you see those 65 plus increasing, those who are 65 plus moving into the workforce. And yes, that's a good thing if those 65 plus want to continue working. But how many of these people don't want to work, but they simply can't afford to live without it? Their pensions are non-existent, their social security simply can't keep up, so they go and do what they can. That's really what's going on here, but they don't want to tell you that. They want to make sure that you just do what you do. Just be quiet, keep your head down, stop asking questions, stop being so pessimistic all the time. The problem is you, not the system itself. You can look at the data another way. 96,800,000, a record number of Americans not in the labor force. The number of Americans counted as not in the labor force, meaning they did not have a job and were not looking for one, increased by 1.7 million. It's just interesting to see these stats piling up, and we don't just look at that number as one individual fact. I think of it like a circle, and you're starting to build around instead of necessarily just one point. This comes from Morgan Stanley, and I'm starting to see a little trend here. We'll see if it continues. On the left-hand side, we expect the unemployment rate to average 15.7% in the second quarter of 2020. On the right-hand side, we expect a sharp upfront pattern of job losses. But if I'm not mistaken, we're looking at something that is starting to change. Essentially, we have this major contraction, but instead of it popping back up immediately, it's kind of taking its time. And that right there could be something that, as we see these new forecasts pile up, it's going to be further and further away from their initial expectation. By the way, the blue line here is 2008. It really wouldn't surprise me, so we'll see what happens. I can't really make predictions based on this because we don't know the situation. When those stores, those factories, those businesses start to open back up, that's going to give us some really good idea of what's happening. Now, it has been said that stocks will actually rebound before the economy does. And why? Because of that buy the dip mentality that so many have. Well, I got some news for you on that. Here you can see it on a chart form, non-farm payrolls change. We're going to collapse territory. Look at what happened during the financial crisis. Everybody talks about it like this was the most extreme thing ever. Oh my goodness, that will never happen again. Well, take a look at what we're dealing with today. It's not just a temporary thing that they keep talking about. This could easily, very, very easily cascade and bring in a major financial crisis. Don't be fooled by what they tell you. And this is the private service providing payrolls change, actually worse than what we saw during the financial crisis. Leisure and hospitality payrolls change, absolutely decimated at this point for obvious reasons. New York Unemployment Fund nears insolvency as claims skyrocket. Now you have to think about that for a second. The institution that bails you out is going to need a bailout. What does that tell you about the way that this entire system is set up? It's just like your insurance at your bank, the FDIC, the CDIC, wherever you live, they got something that protects your assets in the bank. The only problem is if that bank actually did go under, they couldn't bail you out. They would need to seek a little bit of those funds from the central bank. It's only there for show. There's more detail in here if you want to read it specifically for New York, but you know this is going on not just in one place, it's all over. This right here is something that people need to understand, how we can go from this type of crisis to a 2008 type crisis. Mortgage defaults could pile up at a pace that dwarfs 2008. This comes out of Bloomberg. Check it out. Right at the top here, up to 30% of home borrowers may need help. Imagine, think about that for a second here. The implications of a 30% delinquency. None of these companies could handle that. This is so extreme. And while that's just one possibility, it's a very real possibility, and it's going to create a massive problem that cannot be resolved simply by taking Fannie Mae and Freddie Mac and putting them onto the backs of the taxpayers like they did last time around. Mortgage lenders are preparing for the biggest wave of delinquencies in history. If the plan to buy time works, they may avert an even worse crisis, mass foreclosures and mortgage market mayhem. Essentially, the way it works is that people don't need to pay up on their rent, on their mortgages for a period of time. If enough of those people do that, it's going to bankrupt the companies. As it says down in this paragraph here, this is an unprecedented event. The great financial crisis happened over a number of years. This is happening in a matter of months, a matter of weeks. So we don't know what the numbers are going to look like, but certainly they will be big. They will hit hard. And I really don't think it's going to be this V-shaped recovery we keep hearing. You see that in basically every article, every newscast. It's a V-shaped recovery, V-shaped recovery. I just don't understand how that's possible given the situation. Under Armour will lay off about 6,700 employees, quote unquote, temporarily. This is just one company. It happened to come through. I'm just giving you some of the data here. There's so many different types of companies, all different types of businesses and sectors are all affected by this. All right, now this is a two-part note I wanted to make for you. Delta Airlines says it expects its second quarter revenue to be down 90%, and the company is burning through $60 million in cash every single day. Now, if you go back a little bit in the pages of history, you're going to see Warren Buffett. And didn't he buy something? Didn't he purchase something and it was brought into the news and the stock climbed as a result of that? I saw a few comments talking about how, well, if Warren Buffett bought it, it's got to be a great buy. Stocks should rise from this point because the guy knows what he's doing. Well, just in, Warren Buffett's Berkshire Hathaway sells 13 million Delta shares and 2.3 million Southwest shares. My, how quickly things can change. But what's funny is the mentality out there of so-called investors, or I would call it speculators, it becomes laughable when 1 month difference has a complete change of mentality for some. It doesn't make sense. Yes, I understand you want to profit from what's happening, but don't be ridiculous about it. Really quickly, you're looking at the PMIs, as you can see, down and down and down. But of course, as I always mention, we see the trend from 2018 all the way through. That's what we're looking at. Of course, we have a very serious contraction. It's been going on just for a short period of time. But when you see the trend line, it's 2018 into 2019, all the way into 2020. It's continuing. This basically shows the same thing, and can you spot the one that doesn't belong? The outlier here? Well, there are 4 countries that are showing their PMIs: US, Euro, Japan, and one other. And which one makes you smile? Which one makes you laugh as it did to me? Same piece of information here. You're looking at IHS Market Services PMI has absolutely taken a beating, moving its way below 40. Anything under 50, of course, is a contraction, and this has really collapsed. And it wouldn't be a Money GPS video without something to do with the Federal Reserve. This is interesting because this is the Fed Treasury mortgage-backed security purchases since the restart of QE, and you're looking at an actual contraction. Of course, they're still buying a hell of a lot of everything, but you can see the trend. They're reducing the amount of treasuries and mortgage-backed securities that they are purchasing. I think the information that they released was something like 50 billion. It's a big number, but it isn't where they were at before. They've got a problem. They created a big issue inside of these markets. They were making themselves the only player in town. I had just brought you some information a few days ago saying how the companies that were involved are saying, please stop it. You're going to bankrupt us. That's how bad the situation has become. Okay, so that's it for this video. I had so much more information to talk about the triple B rated bonds. I'll just mention it really quickly. Look, if you're here at this point in the video, you're one of my subscribers, my loyal subscribers. I just want to give you this piece of data. Hopefully I'll do a video about it tomorrow. But you remember those triple B bonds? Well, I told you about how they would get downgraded, and that's going to be a really big problem. Well, guess what? It has started to happen. So definitely stay tuned for that one. I'm going to end this video here. If you found it informative, please give me a thumbs up. I really do appreciate it when you do so. When you leave me these comments, I want to thank you for doing so because it really helps the channel out. So thank you very much. If you want to see content from me on Instagram and on Twitter, I do different stuff than what you're seeing here. So definitely check me out at The Money GPS. Selling online is big, I'll tell you right now, especially what's happening at this time in 2020. Very, very serious. If people aren't aware of how to create a second income for themselves, they're going to be burned. If not this time, there will be another. Doesn't have to be with what I'm showing you here with e-commerce, but certainly a secondary income is truly important. I created this e-course for my subscribers for free. It's at the amazongps.com. If you want to learn about the financial education that was robbed from you intentionally to make sure that you wouldn't know how to deal with your own finances, I've created these 2 books to make it super simple for everyone. Check them out at the link in the description if you want the audiobook. Instead, it's at themoneygps.com. If you want the solutions, if you want to know what's going on, well, then you want to watch this playlist. Almost nobody at all makes it to the end of the video, but for those who do, you know that I have a playlist called How To and Solutions. Definitely check it out. I'll see you there.